The market just dropped 20%, and you're watching your investment account bleed red. Your stomach is in knots, and every financial news channel is screaming about recession and disaster. Your first instinct is to sell everything right now, to stop the bleeding, and protect what's left. Your neighbor already sold all his stocks, and he's telling you to do the same before it gets worse. But there's a quiet voice in the back of your head asking, what if this is wrong? What if there's a smarter move I could be making right now? Here's the truth that wealthy investors know, but nobody talks about during crashes. Market crashes are not disasters to run from. They're opportunities to run toward. The investors who build generational wealth are the ones who know what to do when everyone else is panicking. And today I'm going to show you exactly how to invest during a market crash, step by step, so you can turn fear into fortune. Let's start by understanding what's actually happening during a market crash and why it creates opportunity. A market crash is when stock prices drop sharply and quickly, usually 20% or more from recent highs. This happens because investors get scared about something, the economy, corporate earnings, geopolitical events, whatever, and they start selling their stocks. When everyone's selling and nobody's buying, prices drop fast. But here's the critical thing to understand. In most cases, the underlying businesses haven't changed. Apple is still making iPhones. Amazon is still shipping packages. Microsoft is still selling software. The companies are the same, but the prices of their stocks are suddenly way lower. That's a sale. When your favorite store has a 50% off sale, you get excited and buy more. But when the stock market has a 50% off sale, most people panic and refuse to buy. That's backwards. And understanding this mindset flip is the first step to investing successfully during crashes. Before we talk about what to do during a crash, we need to talk about what not to do, because this is where most people destroy their wealth. The absolute worst thing you can do during a market crash is panic sell. When you sell your investments during a crash, you're converting temporary losses on paper into permanent real losses. Let me explain what I mean. If you bought a stock for $100 and it drops to $60 during a crash, you haven't actually lost $40 yet. It's what's called an unrealized loss. The loss only exists on paper. Your account shows you're down 40%, but you still own the shares. If you just hold on and do nothing, and the stock eventually recovers to $100 or higher, you haven't lost anything. But if you panic and sell at $60, you've now locked in that $40 loss. It's real, it's permanent, and you've given up any chance of recovering when the market bounces back. Every single market crash in history has eventually recovered. It's the 2020 pandemic crash, the 2008 financial crisis, the 2001 dot-com bubble burst, the 1987 crash. All of them eventually recovered, and the market went on to reach new highs. The people who sold during the panic locked in massive losses, and many of them never got back in because they waited for things to feel safe again, which usually means prices had already recovered. The people who either held on, or even better, bought more during the crash, ended up making life-changing wealth. So rule number 1 during a market crash is do not panic sell. Turn off the financial news. Stop checking your account balance every 5 minutes, and resist the urge to hit the sell button. You can't handle watching the volatility. Literally just don't look at your accounts for a few months. I'm serious. Out of sight, out of mind can be a legitimate strategy during crashes. Now let's talk about the proactive strategy, how to actually invest during a market crash. The first thing you need before you can invest during a crash is cash available to invest. This is why having an emergency fund separate from your investments is so critical. If all your money is already invested and you have no cash reserves, you can't take advantage of the opportunity when stocks are on sale. Ideally, you should always have 3 to 6 months of living expenses in a savings account that you never touch, except for real emergencies. This money is not for investing. It's your safety net. Beyond that emergency fund, if you can build up some additional cash reserves, maybe another few $1,000s, you put yourself in position to buy during crashes when everyone else is forced to sell. When a crash happens and you have cash available, the strategy is to buy quality investments at discount prices. But you need to be smart about what you buy and how you buy it. For most beginners, I do not recommend trying to pick individual stocks during a crash. Yes, there are amazing deals on great companies, but figuring out which companies are temporarily down versus which ones are in real trouble requires expertise most beginners don't have. The smarter, safer approach is to buy broad market index funds. An S&P 500 index fund, or a total stock market index fund, gives you exposure to hundreds or thousands of companies all at once. When you buy an index fund during a crash, you're betting that the overall market will recover, not that you picked the right individual companies. And betting on overall market recovery has been a winning strategy throughout history. Here's how to think about buying during a crash. You don't need to catch the absolute bottom. In fact, trying to time the exact bottom is impossible and will drive you crazy. The market might drop 20% and you buy, thinking it's a great deal, and then it drops another 20%. That's okay. You're not trying to be perfect. You're trying to buy quality assets at prices lower than they were before the crash. A technique that works well is to invest in chunks rather than all at once. Let's say you have $6,000 you want to invest during a crash. Instead of throwing it all in at once, you might invest $2,000 now, another $2,000 if the market drops further, and the final $2,000 a month from now, regardless of what happens. This spreads out your risk and ensures you're not going all in at the wrong moment. Let me give you a real example from recent history to show how this plays out. In March 2020, when the pandemic hit, the stock market crashed about 35% in a matter of weeks. It was terrifying. Unemployment spiked, businesses shut down, nobody knew how bad it would get. A lot of people sold everything. Some investors, the ones who understood that crashes are opportunities, bought index funds when the S&P 500 was down 30%. Within 5 months, the market had fully recovered. Within a year, it was at all-time highs. Those investors who bought during the panic made 30, 40, 50% or more on their money in a very short time. Meanwhile, the people who sold locked in huge losses, and many of them missed the entire recovery. Or let's look at the 2008 financial crisis, which was much worse and scarier than 2020. The market lost over 50% from peak to bottom. The recovery took years instead of months. Not even in that scenario. Investors who bought quality index funds when the market was down and just held on ended up doing incredibly well. By 2013, the market had fully recovered. By 2020, it had more than tripled from the 2009 lows. Someone who invested $10,000 in an S&P 500 index fund at the bottom of the 2008 crash would have over $30,000 by 2020. That's the power of investing during crashes and being patient. Now, I need to address the fear that stops most people from investing during crashes. What if this time is different? What if the market doesn't recover? What if we're heading into a depression and everything goes to zero? These fears are real and legitimate, but let's put them in perspective. The stock market represents ownership in businesses. For the market to never recover would mean that businesses as a concept have failed permanently, that companies stop creating value, that the economy never grows again. In over a century of stock market history, through to world wars, the Great Depression, multiple recessions, terrorist attacks, pandemics, and every crisis you can imagine, the market has always eventually recovered and gone higher. Could this time be different? Technically, yes, anything's possible. But betting against the long-term resilience of human innovation and economic growth has been a losing bet for over 100 years. Another key principle for investing during crashes is to keep your regular investment schedule going. If you've been dollar cost averaging, investing the same amount every month regardless of market conditions, do not stop during a crash. In fact, this is when dollar cost averaging shines brightest. Your monthly investment is buying way more shares at these lower prices than it was before the crash. Every share you buy at discount prices is a share that will generate returns when the market recovers. Stopping your regular investments during a crash because you're scared is exactly backwards. That's like refusing to shop during a sale because prices are low. Keep investing, keep building your position, and let those cheap shares compound over time. I also want to talk about the emotional and psychological side of investing during crashes, because this is honestly harder than the financial side. When you see your account balance drop by thousands or tens of thousands of dollars, it triggers a fear response in your brain. You feel physical stress, you lose sleep, you can't stop thinking about it. This is normal. Your brain is wired to avoid losses, and seeing money disappear activates the same fear response as physical danger. But you have to remember that investment losses during a crash are not the same as money actually disappearing. You still own the same shares of the same companies. The market is just temporarily repricing them lower. If you don't sell, you haven't lost anything real yet. One technique that helps is to zoom out and look at the long-term chart. Pull up a chart of the S&P 500 over the last 50 years. You'll see crash after crash, each one looking terrifying in the moment. But when you zoom out, they're all just tiny blips on an overall upward trend. The crash you're living through right now will look the same way 10 years from now. A small dip on a chart that's steadily climbing higher. Keeping this long-term perspective helps you stay calm and make rational decisions instead of emotional ones. Let me also address what to do if you don't have extra cash to invest during a crash. Maybe you're just getting started, or all your available money is already invested, or you're dealing with your own financial challenges. That's completely okay. The most important thing you can do in that situation is simply not sell. Hold what you have. Keep contributing to your regular investment plan if you can, and wait out the storm. Not losing money by panic selling is almost as valuable as making money by buying during the crash. You're still way ahead of the people who sold low and locked in losses. It's also worth mentioning that market crashes come in different flavors. Sometimes it's a quick, sharp drop, followed by a relatively fast recovery, like in 2020. Sometimes it's a slower grind downward followed by a years-long recovery. It's like 2008. Sometimes the market goes sideways for a while before resuming its upward trend. Can't predict which type you're dealing with in the moment, which is why the strategy stays the same. Don't panic sell. Buy quality assets at discount prices if you have cash available. Keep your regular investment schedule going, and be patient. Before we wrap up, I need to give you the disclaimer that everything in this video is for educational purposes only and not financial advice. I'm not a licensed financial advisor, and your personal situation is unique. Market crashes are risky, and there's no guarantee that the market will recover quickly or at all. You should do your own research, understand the risks, and consider consulting with a professional before making investment decisions during a crash. My goal is to give you perspective and strategies, not to tell you exactly what to do. So here's what I want you to remember. Market crashes are scary, but they're also opportunities for patient, long-term investors. The worst thing you can do is panic sell and lock in losses. The best things you can do are hold your existing investments, keep your regular investing schedule going, and if you have cash available, buy quality index funds at discount prices. You don't need to time the bottom perfectly. You just need to be brave enough to buy when everyone else is selling. History shows that every crash has eventually recovered, and the investors who stayed calm and took advantage of lower prices ended up building significant wealth. Market crashes are one of the great wealth transfer events in the economy. Wealth moves from people who panic and make emotional decisions to people who stay calm and think long-term. You get to choose which group you're in. It's not about being smarter or having insider information. It's about having the right mindset. Understanding that temporary price drops don't change the value of quality businesses. And having the courage to act when everyone around you is running scared. Crashes feel awful while you're living through them. Your account balance drops. The news is terrifying and it seems like it will never end. But it always does end, and when it does, the people who stayed invested or who bought during the crash are the ones celebrating, while everyone else is kicking themselves for selling at the bottom. If this video helped you understand how to think about and invest during market crashes, and gave you the confidence to stay calm instead of panicking next time the market drops, I'd really appreciate it if you hit the like button. And if you want to keep learning about long-term investing strategies that actually work through all market conditions, subscribe to the channel. In the next video, I'm going to show you exactly which index funds are best for investing during crashes and how to know when to buy. Thanks so much for watching, and I'll see you in the next one.